Hey everyone. Last week I attended the National Multifamily Housing Council Conference in San Diego, where I had the opportunity to meet with a wide range of investors. And at those meetings, investors shared their thoughts on the investment outlook for 2024. Although this was a multifamily conference, I think that many of the insights I gathered apply to all types of commercial real estate. Most of the investors were focusing on the recalibration of the market and what it will take to narrow the buyer-seller expectation gap. Several investors indicated that they hadn't completed a transaction in more than 18 months, but most believe that activity will revive in 2024. No one was saying the market would get back to the level seen in 2021 or 2022, but there was a broad consensus that activity in 2024 will be stronger than it was in 2023. Central to that theory is the belief that the economy will remain stable and uncertainty will continue to abate. And that, in turn, will help narrow the expectation gap. A key ingredient of that stabilization theory is the belief that the Federal Reserve will reduce interest rates this year. And while the conference was underway, the Federal Reserve met and delivered their newest rate policy. As was widely expected, the Fed kept rates flat with a lower bound of 5.25%. But Chairman Powell did once again leave the door open to rate cuts later this year. And if the Fed begins to cut rates, it will send a powerful message to the banks and the financial markets. It will signal that the Fed believes inflation is under control and that the economy is ready for a positive forward nudge. But while the first Fed rate cut will be viewed as a positive, whether it happens in May, like Wall Street believes, or in June or later in the year, it will be the second rate cut that will really trigger positive momentum for commercial real estate. The second rate cut will define the trend, and it will send a clear signal to lenders that rates are on a downward trajectory. At that point, lenders may begin to tighten the safety spreads they've added to their lending rates. Historically, when rates were generally stable, lenders maintained a spread of about 150 to 200 basis points over the underlying interest rate basis, like the 10-year Treasury. But over the last couple years, as the Fed battled inflation by raising rates, lenders widened that spread to about 300 basis points. They increased their spreads to cover their risk in the volatile, upward trending interest rate climate. But if the Fed clearly commits to reducing interest rates, then lenders can begin to reduce their safety spreads. That in turn will reduce the cost of debt capital for commercial real estate investors, and that will help narrow the expectation gap. In turn, the flow of commercial real estate transactions should accelerate. And while the overnight rate and the 10-year Treasury don't always move in tandem, such a significant rate drop by the Fed could push the cost of commercial real estate debt capital down substantively. That outlook is a big part of why the investors I spoke with are cautiously optimistic about their ability to get transactions done in 2024. But it's important to note that they didn't predicate their activity on a rate reduction. They clearly indicated that they plan to get off the sidelines this year and start putting their commercial real estate capital to work in 2024. In addition, a lot of the private investors I spoke with plan to get active soon. They believe the institutional capital, which has been pencils down for about 18 months, will reawaken at some point in 2024. And the large private investors want to get a step or two head start before the big money comes back into the market, which means competition for assets may begin to rise as the $240 billion of dry powder on the sidelines begins to activate. It probably won't be a fast transition, but it will likely build momentum over the course of the year. And as that transition takes place, the investment market dynamics and underwriting standards could shift, which is just one more reason investors need to keep their eyes on the horizon.